Sustainability, for me, is synonymous with resource efficiency. That really is the key. When I look back at everything I've done over the last 17 years and I look at the way the world works, the thing that's astonished me and motivates me more than anything is how much more efficient we can be with the use of our resources. When you wake up in the morning and say we're wasting 3/4 of the world's energy, half of the world's food, and 1/3 of the world's water, that's a deeply motivating set of facts. And we've now built projects in our portfolios that connect to over 50,000 properties in 10 countries. We've solved these problems for steel mills, chemical plants, hospitals, government buildings, logistics parks and facilities. This is what's exciting. This basic problem that we identified years ago, there are solutions to the problem. And we've built a portfolio now of over $2 billion of projects which solve these problems. Our business model is that we run funds and we run those funds on behalf of institutional investors that bless us with their trust to invest their capital in projects that are sustainable, not just for the environment and society, but commercially sustainable. Indeed, if it's not commercial, it's not sustainable.
Jonathan, thanks for coming on the show today.
Thank you. I'm really excited to be here. Thanks for having me.
I'm going to start by setting up a backdrop of your journey to becoming an international investment advisor and investor focused on environmental infrastructure and energy efficiency, and do this for listeners who don't know you. So could you please describe your childhood? And I'd like you to also talk about your parents and your family and any other formative experiences you had growing up that might have influenced you to work essentially most of your career in sustainable infrastructure investing, just to give a bit of color so we get a good idea from where you've come and your journey to sustainable investing.
I grew up in central London. I live in central London. I married actually to a central London girl, so it makes me a rarity, I think, here. And I have 2 central London kids.
So you've never been outside of zone 1 and 2, is that what?
What I'm pleased to say is I spent most of my investment career, business career, internationally, actually, and but very much born and bred in the UK. And it's not necessarily the most natural place to start to connect to your natural environment, right? You'd think in the middle of town, but it was very interesting when I was a kid at school in the late 70s, early 80s. There was a lot of writing at the time, actually, about resources and the transition of the world into a more sort of resource-dependent, mineral-dependent world. I think some very interesting thinking at the time about what might happen in the East with China, what might happen to resource-rich regions and nations like Africa. Al Gore actually started writing about that time, some pretty extraordinary documents and papers around the topic of environmentalism. Probably people don't really think about it like this, but the Thatcherite conservative government of the 80s was actually quite an interesting time to start thinking about the connection between the Earth, particularly as we would think, as the world was starting to pay more attention to global environmental challenges, ozone layer, perhaps fast forward into a more modern era of climate change concerns. So that was kind of a bit of a backstory. I got interested in the interface between stuff like resources, metals, minerals, geopolitics, environment. And then went to university and studied history. And I wrote about this in my book, actually, but that's probably the biggest single sort of educational shift I ever had, because they told me just to ask one question. So after 3 years, I studied really hard. And after 3 years, they told me something that was really the most important thing. I wish they'd have told me at the beginning. They said, there's only one question you need to ask in history. So what? That question was something I took out of university and took into my business career and sort of building up a career in the investment world. There were lots of opportunities to ask yourself, so what? But as I developed my career, I started in media, but then I went into investment, telling stories to finding stories to invest in. There was one moment in my early 30s when that question, kind of so what? And all of my interest in geopolitics and stuff and the environment all came together in one moment. And that was really the kind of the gating point or the changing point of my sort of career.
So let me back up a minute. We jumped from growing up in central London to almost post-university. What sort of elementary school, boarding school? I mean, was there anything there that you started to think about, or that you can draw any lines to this, or no?
I grew up actually in a school that didn't have any kind of religious association per se. As it happened, it was a school in North London that was pretty much 90% Jewish. I think the culture that in those days, and I'm talking about kind of the early 80s really here, the culture there was a values-based culture. It was about family, and it was about how to think about society and how to think about family. This is not communist political thinking. This is just thinking about the wider society around you and how you fit into it. So I think that was a big part of my cultural upbringing, actually, just thinking about values basis. I mean, we're here on the SRI podcast, but I think values was a very important part of the thinking when I was a kid. When I was at school, values was a really important part of how we thought. I went to Westminster School in London. It was a very academic place, but it was very values based, and it was just a very old heritage school, part of the fabric of the UK.
And then in 1992, you went off to University of Oxford and earned a degree in, wait for it, modern history of all things. Now, you're known as an international banker who becomes a pioneering sustainability investor, but that's clearly not where it began for you. So let's start with why Oxford, and then why study modern history of all things? And was there anything there that planted a seed that developed into your eventual interest in finance and energy markets and ultimately sustainable investing?
The honest truth about why I went to Oxford, I had decent academic record when I was at school, but the honest truth about why I went to Oxford is I asked my history teacher where I should go. And it was all about the climate. She said, Cambridge is too damp, go to Oxford. It's actually a true story. And I knew so little about all of these things. I said, okay. And I said, where should I go? And she said, hey, you should go to, because, Westminster School was right smack bang in the middle of London. She said, you should go out somewhere that you could get a bit more of a natural environment. So go to Lady Margaret Hall, which is on the outskirts of Oxford by the parks. And look, you've grown up in a boys' school, so it's a mixed college, right? So go there. It's a ladies' college. That honestly, those were the reasons, and had a good rating for history. But so that was the choice. Why modern history? I love stories. I still love stories. I write books and talk, and frankly, in my day job, whether or not I'm trying to convince people to do things differently with the use of energy or invest differently, so much of it is about storytelling, right? And I loved the stories in history. I loved the concept that you could understand why things are how they are now with reference to, because if you studied how they became so, that was really the kind of the fundamental point for me. It's like, if I try to understand how the world works, okay, there's all of the sciences and the rest of it. But if I really want to understand how the world works, I really need to understand how we got here. And that was what history was about. And that was my journey that took me to Oxford. And the so what thing sounds facetious, but it's really not, because then that takes you on to the next level. I mean, so what? So what? We know that this sequence of events got us to where we are. But what are the conclusions we're going to draw out of it? And actually, interestingly enough, in government, society, business, for people, what are we going to do about it? Like, what does this tell us about what we should do next? And, are there patterns? Are there patterns that we can start to recognize that can inform how we chart a path forward? So for me, it might sound absolutely crazy that you should study history and become a banker or an investor. But actually, I think it's probably one of the best groundings you can possibly get, because how did we get here? Why? Now what are we going to do about it? And, those are actually the fundamental questions that come from that discipline.
In 1995, after you completed your studies there, you thrust yourself upon the market with your newly minted modern history degree. And then what did you do?
I went straight into journalism.
Tell me about that.
When they used to come around and do the what they used to call the milk round in those days. So you'd have all of the companies turning up at Oxford looking for undergraduates. Actually, the last thing I ever would have done would turn up and go for a job in the city. In fact, that was something I swore I wouldn't do. I was romantic. I wanted to be a journalist or in media or in advertising or something like that. So my first job, I worked for the Sunday Times. I found that I was writing one sentence a paragraph. It wasn't really releasing my creativity at that time. I was offered a job in TV, which I loved, absolutely loved. I got an offer at a job which I took to be a producer for what was then the big commercial TV station, ITV, through Carlton Television. I produced the news program for them, but that was a short-term role, and I didn't have any money, so I couldn't hang around for a permanent job there, although they did offer me one at some point. And I went to work in advertising. And I thought this advertising thing would be great for me because it would be the merger of business, which I love, and stories, creativity, which I love. And, to be fair, I kind of did enjoy it. It was a bit wild, but doing advertising in the 90s, but it didn't give me what I wanted, really. It was quite creative, but it didn't give me the real business or financial grounding. So I ended up taking a position in the industry I said I would never do. And I became my first job was a media analyst in the city. And I'd learned enough in advertising to understand how media companies made money so that I could then join a stockbroking company in the city and start to figure it out.
So this was before HSBC?
This was before HSBC. This was in 1996. I worked for a company called Brewin Dolphin, which is a stockbroker to the gentry. I turned up on my first day wearing brown shoes, and I was told to go home. It was those days. I had a wonderful time there, actually, finding it much more creative being in the investment business than it had been in the media business. I just was absolutely amazed, about how creative you could be. You could design investment strategies. You could create investment companies. You could raise capital. There was this whole world of the capital market behind you. You had to know so much about what was going on in the world, and I loved that interface of information with analysis and storytelling and then action, what you actually do about it. So it was just a fantastic experience. It was as I said, when I was at university, it would have been the last thing I would have ever wanted to do.
Did you have the maths background for that?
I studied really hard. Yeah. I mean, one of my courses at university at Oxford actually was the history of science. There were 12 people that studied it. Actually, it was a very odd module. But I did have kind of a scientific mathematic interest. But when I joined the city, honestly, I needed to, at the beginning, it was because I needed to try and find better financial standing, but also liked the work. I had to study very, very hard, Scott. I got books out. I would get massive books about financial modeling and just spend the time, the evenings, the weekends, working through things until I became the best financial modeler I went through all of the exams, did everything I needed to do. When you're in that kind of young analyst in your 20s, you're either good at maths or you're good at pattern recognition. I think it's probably the way I'd put it. I think I was better at pattern recognition than at maths per se. But the new tools of the 90s and the spreadsheets and the modeling techniques was what I learned to help me turn the numbers into patterns.
How long did you stay in that role, and what did you do after that?
I was there for 6 years. I was approached by HSBC when I was in my late 20s to come on board into their investment banking practice that looked after investment companies on the list, mostly listed on the London Stock Exchange. I took the job. I was super excited. I thought this was going to be my MBA. I mean, Brewin Dolphin was a wonderful training ground, but it was very UK based. And I wanted to be involved with a big international financial platform and really just immerse myself in international capital markets. And, I'm so grateful to HSBC because that's exactly what it did for me. And I got this incredible opportunity. I was promoted young. I think, hopefully I was good at my job, but they thought I was as well. Promoted young, became a director early, just worked really, really hard and took advantage of the opportunity they'd given me. And then after having sort of worked in the UK, in the US, in Latin America, in Asia, I got an opportunity to join the buy side of HSBC. I didn't even know this existed, but somewhere in the background of this building, for 5,000 or 8,000 people in it, I can't remember how many, in Canary Wharf, somewhere there was a part of the bank that invested the bank's own money in infrastructure projects and in real estate projects. And they invited me to join. That was a very exciting day. It was actually a tap on the shoulder in a coffee shop at the bottom of the building. Hey, would you like to come and work for us? And it was one of those life-changing moments. My life changed more again a couple of years later, but that was when I switched from being an advisor to an investor.
At some point, you got involved with an IPO of the HSBC infrastructure company. Now, is that at the point you're on the buy side, is that the infrastructure company, or is this something else yet?
That's exactly what the tap on the shoulder was for. So I'd been working for HSBC looking after the division of the bank that was acted as an advisor and stockbroker to listed investment companies listed on the London Stock Exchange, what they call in the US 40 Act companies, here investment trusts. And I'd been doing that for lots of other clients, but that tap on the shoulder was actually a question. Would you like to come and work for us and see if you can take HSBC's infrastructure portfolio, which we owned with, HSBC at the time owned with sovereign wealth funds. We'd like to see if you can come in and take the portfolio, restructure it and exit it. And that was a very interesting opportunity for me. I loved the idea, but the problem was I ended up doing what I knew how to do best, which was these London Stock Exchange listed companies. So they had never been an infrastructure investment company listed on the main market of the London Stock Exchange. There'd been lots of real estate, private equity, listed securities as investment strategies, but there'd never been an infrastructure project portfolio ever listed on the London Stock Exchange. In fact, it wasn't allowed. So at the time, there were rules in the listing rules that mitigated against it. I had the idea that instead of selling the infrastructure portfolio that HSBC owned, instead that we would list it and we would take it to the main market of the London Stock Exchange. The snag being that the listing rules people had rules against it. So my idea was to change their mind. And so I spent 3, 4, 5 months working very hard to convince the UK listing authority that was in the building next door that they should change the rules and allow us to list a portfolio of infrastructure projects as an investment company. Eventually, after I was told to stop calling them because I was harassing them, eventually they called me up and said, "Okay, we'll do it." And that was March the 29th, 2006. We listed Europe's first ever main market stock exchange listed investment company that invested in an infrastructure portfolio, and it blew open a new asset class actually on the London stock market for listed investment companies in the infrastructure space.
You said that you had the opportunity at HSBC to work in Latin America and Asia, but you always were based in London, or did you go live in other parts?
I was based in London, but I traveled very extensively. We had clients and investors all over the world. So I spent a lot of time in the US, in New York, which is a market which I still love today, and spent a lot of time in the States. Asia was a sort of very important footprint and market for HSBC, obviously the Hong Kong Shanghai Banking Corporation. So I spent a lot of time there working with investors and with the bank, a little bit in Latin America, but those were really the two major footprints outside of the UK. I guess once I was poached to join the buy side of the business and actually after I listed the infrastructure company on the main market of the stock exchange, 2006, the bank then said to me, "Scott, what do you want to do next?" And do you remember 2006? It was like, I don't mean that in a funny way. It was a ridiculous year. Almost anything was possible. Like in my financial career, 2006, it was, you could make anything fly. So the bank said to me, "Hey, what do you want to do next? This has been successful." This might sound completely crazy, but I said, actually, I'm really interested in China. China's been part of the World Trade Organization now for 5 years. HSBC had its 140th anniversary of constant operations in China in 2006. And I said, look, why don't we launch a new investment company to invest in real estate in China? And the bank backed me to do it. They packed me off to Hong Kong. They gave me seed funding. They said, in the nicest possible way, don't go back until you've done the job. My job was to raise what ended up actually being one of the largest international funds investing in Chinese real estate in 2006. But that's exactly when my life changed, because I went there to do that. This was a commercial job, right? I think it's a great idea for us to be investing in real estate in China in 2006 for all the reasons I gave you. But when I arrived, I couldn't see down the street. Landed in Beijing and it was pink dust in the atmosphere. And as it happened, and it's one of these strange things, I'd got back into the kind of reading I'd been doing at school about the environment and economics and stuff, metals, minerals, and the rest of it. And there was some incredible writing at the time. Do you remember Jared Diamond's book, Collapse, which he'd released about that time? And there's a big chapter on China and Elizabeth Economy's paperwork. She was doing work at the time with the State Environmental Protection Agency, and it explained everything. Well, kind of explained everything. What it explained was that at this moment when I landed in China, why couldn't I see down the street? And, the reason was that massive deforestation outside of Beijing had allowed dust to blow straight into town from the Mongolian desert. So you couldn't see down the street. So it was an environmental destruction that had happened. I would then the next week be in Shanghai and I couldn't see down the street, and for different reasons. I couldn't see down the street because of construction dust, but again, I had been doing my homework and my reading, and I knew how this environmental degradation and particularly air pollution in town was killing people, from premature lung disease. And I would then visit some of the more regional places like Xi'an or Chengdu, and you'd find other forms of pollution, sandstorms shutting down factories. And this is exactly what the Chinese government and Elizabeth Economy were writing about in 2006 and Jared Diamond. This was the economy now colliding with the environment right in front of your eyes. They were counting it and they were saying, hey, we're actually losing maybe 10, 12% of GDP a year. So it's such an extraordinary number. It's difficult for people to fathom. I reproduced it in the book that I wrote recently because this is what's happening. Let's count the numbers: the crop failures due to acid rain, factory closures due to sandstorms, the premature deaths in town and the productivity falls. So all of these features were really the economy started suffering, or they were counting it in China exactly how much it was, but the economy was suffering because the environment was bad. And critically, they decided to do something about it. So they published massively important policy statements, which are, I think, Scott, have defined the last 18 years. They published the medium-term economic plan in China, which talks about how to secure the supply chains needed for what's now the clean energy transition. They published the first of a series of 5-year plans to cut energy use per unit of GDP output, so that they could start to get some of these things under control. They started the Billion Trees program to plant, right? Why? They're not because they're particularly any nicer than the next person. It's because they needed to bed down the environmental destruction that was causing massive economic losses. And, but this was all written down. So it was with that, Scott, that I then came back to the UK. That was my turning point I was talking about earlier. That was the moment beyond which I couldn't go on in the same way that I had before. And I actually went back to HSBC and I said, you know what, we're going to be really successful. We're going to launch the largest international fund of its kind to invest in real estate in China. We'd have done our job, but there's a bigger story. There's actually a story that's generational. The world's changing, and I've seen it in China. I've seen what's going to happen in Europe and America, and they're doing something about it. And it's about environmental infrastructure.
Then in 2007, which is the year after that experience, you left HSBC to found Sustainable Development Capital. So I want to know how this came about. I want to drill down and understand what is the timeline or the series of events that lead you from working with a very large bank to deciding to jump out on your own and do a startup venture where you established Sustainable Development Capital. And what was the opportunity you saw, and why did sustainable investing interest you at that point? And I know we're covering earlier chapters here in your career, but I really like looking at these things closely because it shows the development that you went through. And these were very early days of sustainability and responsible investment. And this must have been far from a sure thing for you. And I think that makes a fascinating study because people get to see how you got to the point to strike out and create something. And as we've seen already, your career wasn't exactly a straight line from modern history studies at Oxford to SDCL, was it?
Looking back at the arc of the story, I think it makes sense now, but you're absolutely right. It wasn't necessarily what I would have predicted at the beginning when I set off on my journey. The answer to that is that, I came back from China with that conviction and very, very profoundly felt that I didn't have just this kind of a point of view, but I had the evidence base, which looked at a major tipping point, a major transition that was going to happen in energy, the environment, and the economy. And these were all massively interlinked. By the way, when I was a media analyst, there were two or three sectors that defined the beginning of my financial career as the coming together of telecoms and media and other forms of communication, or what they called TMT at the time. So for me, this was the next big change or wave of coming the environment, economy, and energy. So that's what I came back from China with. So when I went to HSBC and said, we need to take this and think about what it means if we think about environmental infrastructure. We at HSBC and everything I'd done previously on infrastructure at HSBC had all been about what we call social and economic infrastructure, healthcare, education, transport, government buildings. What does it all mean? It's actually very profound, but it's essential services without which society doesn't function. That is the definition that the investment community used for social infrastructure in the early noughties. Very profound, like very meaningful work to do, actually, if you think about it. But here I came back and said, well, hold on a second. Now we've got something that's, I think, just as meaningful, something called environmental infrastructure. Now, if you think about that as essential services without which society doesn't function, what is it? It's energy and it's water and it's waste and it's transport. But look at China. If you don't provide these services sustainably, it's not going to work, and it starts to cripple your economy, because if you have an energy system which can't service the economy. You'll have water and waste systems that don't. I mean, their aquifers have depleted waste systems up the spout, transport. I don't know if you remember, but they were building high-speed rail links literally to nowhere in the middle of Shanghai. So the point was, how do you make these services more efficient and build environmental infrastructure? So it's with that I went back to the bank, Scott, and said, look, let's do this. Let's set up a division of the bank just to focus on environmental infrastructure. Cricket's noise came out. And then the next thing that happened was they said, and I love HSBC, by the way, but then HSBC, I've got everything to be grateful for. It's a very honorable place. But they said to me, look, Jonathan, we're not ready yet. We've just printed our millionth credit card in China. We think that there is a risk that renewable energy, which is a very early stage development at the time, might not work above $50 a barrel. Sorry, below $50 a barrel of oil. And, good idea, but it's too early. So it was with that conviction, Scott. That's why I set up SDCL. I was at home in bed. I was so frustrated one Saturday morning, so passionate about doing this that I went online and I found in Companies House, you register companies, and I found the name Sustainable Development Capital was available. So I bought it and I opened up the company. And on Monday morning, I went into HSBC and I said, thank you, but I'm passionate about this. I'd like to do it. So I'd like to set up a company just to focus on environmental infrastructure.
Just like that.
Yeah.
Over a weekend, right. SDCL is a fairly broad company now with operations across project management, advisory, real asset investment, private equity. We'll get to all that in just a sec, but tell me, what did SDCL look like in the early days on Tuesday after you went to HSBC on Monday? And said, guess what, guys? What was your original focus?
Actually, what was interesting about HSBC's reaction, because it's an extremely good institution, is that they said, look, okay, fine, but hold on a second. Wait, what exactly did you mean by environmental infrastructure? So actually, what my first day at work on October the 10th, 2007, that was the first day of SDCL's trading. What my day looked like, because actually I turned up at HSBC in the morning, because what they asked me to do is they said, look, we actually think this is a rather good idea. We'd like you to explore it more deeply. We get that you want to set up your own financial institution, but why don't we be your first client? I spent the morning at HSBC. I packed up my boxes and I put them in the back of my, ashamed to say, my car. And at the time, and I drove across town, and I drove very close to here, actually, into the middle of Mayfair. Opened up in a little office with two people in it. me and one other, and carried on doing the same job. And we actually designed our first job at SDCL was designing a fund, which ultimately that was launched and successfully invested by HSBC, called the HSBC Environmental Infrastructure Fund. So for the first 5 years of our life, from 2007 to 12, the role that we played as a financial institution was advisory. And we've been investment since 2012, but it was advisory up until 2012. And that was our first deal. It was designing funds for the likes of HSBC. We did it for the World Bank and other financial institutions, the IFC, but designing funds with an investment policy strategy and approach, which would invest capital in various stages of the infrastructure project lifecycle and in the supply chain for infrastructure projects that were associated with environmental infrastructure. So, projects ultimately that were good for the environment and society. So HSBC was our first client, actually had a very, very interesting business. We loved it, got to, again, get to know most of the governments and their attitudes in the late noughties and after the great financial crisis, how they wanted to channel capital into these markets, what technologies they were interested to support, got to know the investment community well, and also got to know what the investment market was prepared to do, Scott, and also what it wasn't. Where were the funding gaps going to be? At the time, like renewables, even now, everybody thinks renewables is something new. Actually, renewables was already getting pretty big in the late noughties. I mean, the world's invested 9 trillion over the last 20 years, most of it more recently, but still there'd been a pretty substantial amount of money invested by the end of the first decade of this century. But nobody, this is the thing that really taught me, there were things that nobody was looking at. There were like gaps, complete gaps. And the biggest gap that I saw is what we do today. The biggest gap was, well, everybody was perfectly prepared to build something new, build a new power plant or build whatever it was. Nobody was interested in how to make the infrastructure more efficient, how you could build systems that actually did the same or more, but used less. So, this was the big thing for me. It was a sort of a journey of understanding the capital market was very good at building stuff and very bad at identifying how to address more gritty problems, like the biggest, dirtiest secret of the energy sector that I've learned over the last 17 years, most of it's wasted. That's the piece that we stepped into as an investor in 2012. But it was because of the information of the last 5 years.
So, Jonathan, maybe this is a good time to put a pin in this just for a moment. And you can tell me, what does sustainability mean to you personally? By this time in your life, you've made the decision. Obviously, you were voting with your feet. And you made the decision what you're committing your life energy to, right?
Sustainability, for me, is synonymous with resource efficiency. I don't mean to get too boring or technical, but actually, that really is the key. When I look back at everything I've done over the last 17 years, and I look at the way the world works, and the reason I wrote my book partly was to put all of those pieces on the table and see if it was still the same. The thing that's astonished me and motivates me more than anything is how much more efficient we can be with the use of our resources. Because going back to my childhood and my political convictions, the resources, meaning the stuff that we've always been mining, extracting, searching for, competing for politically, that stuff, and now that we're burning it, is creating climate change. That stuff are creating problems like conflict and climate change. But here's the exciting thing. We waste most of it. The reason I find that exciting is that that's a solvable problem. Like, if you were to wake up every morning and say, oh my God, what do we do? Like we've perfected the way that we operate, right? We're doing the best we possibly can, Scott. There's nothing more that we could possibly do. And yet, no good deed goes unpunished. Nothing more that we can do. And it's just getting worse. Okay, that would be a challenging thing. But when you wake up in the morning and say, we're wasting 3/4 of the world's energy, half of the world's food, and a third of the world's water, that's a deeply motivating set of facts. I think the other feature of it, though, is that it's motivating because you can design solutions to those problems. In fact, we took the I in SRI. Actually, that's what investment is all about. Investment is about trying to identify inefficiencies. Business is about trying to solve problems. So for me, sustainability or sustainable development for me is synonymous with resource efficiency, doing the same on what with less, just using less resources, because we just use too much. We exceeded all of our planetary boundaries and the rest of it. But sustainable investment for me actually means solving those problems from a business perspective. And from an investment perspective, investing in inefficiency and solving those problems for me is the highest impact, most sustainable thing that we can do. You could argue there'll come a point in 25, 30 years when we would have arbitraged out from an investment perspective or perfected some of the inefficiencies. But we're so far from that, Scott. And solving that problem, how much of the stuff that we waste or squander today and the carbon and the cost of that, solving that problem for me is what the essence of sustainability is. More important than building new stuff is making sure that we're using the existing stuff more efficiently.
Is that true? 3/4 of the world's energy is wasted?
That question is the other reason I wrote my book. I'm a busy guy. I've got a business to run and the rest of it. And we've got $2.5 billion invested in 10 countries, 50,000 properties and so on. So, and I've got a family, and they would probably have not lost me to, my computer screen for a year to do this. But it's actually to answer that question, because it's so nuts, isn't it? It's extraordinary and it's unbelievable. And it sounds crazy. I'm very grateful to my publisher. It's a division of Hachette, Hodder and Stoughton, who published it, the second largest publisher on earth. But it's partly because I wanted to demonstrate this. But I'll break it down very quickly just to give you, conceptualize it so it doesn't sound as nuts. In the energy sector, you have to get energy from somewhere. 80% of it's oil, gas and coal. So generally speaking, you lose, first of all, about 10% of the primary energy just in extraction and conversion into the system somewhere, to pipes, into making it into a grade that it can get used in the energy system, say in power plants or in the transport sector. So it's about a 10% loss, 9%, 13%. That's a small part. The biggest part of the world's energy gets lost as heat. It's about half of it. In fact, that's being charitable. About half of the world's energy gets lost as heat. For example, everybody thinks of electricity, so I'm just going to go along with that for a second. But if you think about a power plant, like a gas-fired power plant, which is the largest fuel source for power in any major economy at the moment, if you put a molecule in a power plant, half of it turns into electricity, the other half turns into heat. By the way, which is fine if you use it, but if you've got a centralized power plant, which is how we've built the energy system in America and in Europe, centralized power plant, the electricity goes into the grid, but the heat goes up and there's nobody close to use the heat. So they just dump it, it wastes. It goes, in fact, it doesn't disappear. It just goes up into space where it's not really needed. But think about this. By the time the power has come out of the power plant, 60% of the primary energy, the original fuel, has been lost. 60%. Now, then it goes on to the transmission and distribution wires. So by the time it's in your building in Mexico or mine in London, another 10%, so 60% plus 10% has been lost on average. So in the United States, since the 1970s, the Lawrence Livermore National Laboratory has been calculating what they call useful energy. That is the amount of energy that gets from the primary energy source to the end user. And then what they call rejected energy. In other words, the amount of energy that gets lost in the system. And very broadly, it's been between 67 and 70% since the 70s. There's lots of things that haven't changed since the 70s. We're still almost entirely fossil fuel based as we used to be. And we still waste most of our energy, even before it gets to the point of use.
That's extraordinary. I'd love to drill down more on that, but we got to get to SDCL. Maybe you could start with a high-level overview of SDCL and maybe start at the beginning with its mission and just describe at a high level for a moment its activity, investing focus, and you could walk us through the timeline of SDCL to becoming what it is today, because you started out as advisory and now you're investing.
That problem that I just described, the fact that we waste most of the energy, is actually the mission. It's the mission of SDCL is to solve that problem. And tying a little bit back to kind of the prehistory, the first 5 years I described to you earlier as doing a lot of work for financial institutions. But there was another side to our business in parallel, which illustrated to me the opportunity of solving the problem. It wasn't just financial institutions that hired us as an advisor, it was companies. And it's companies to solve the physical problem, because the companies recognized, as it stands today, that 90% of their carbon footprint was in their supply chain. And in the late noughties, big companies, I won't name them from today, but very big famous brands wanted to do something about this. And they hired companies like ours, actually, to go out and find solutions to these problems in their supply chain. And we found solutions in energy efficiency, making factories more efficient, reducing the amount of energy that was wasted at the point of the manufacturing process, which reduced the carbon and so on. So by the time we started investing in projects in 2012, with the mission to cut energy waste, to invest in solutions to this big problem, we knew a lot about the subject. We knew that there was a funding gap because of our experience in the financial markets, but we knew literally from the coalface, from working on the ground and factory floors in China, for big international brands, working in hotels and data centers and hospitals, we knew that there were problems on energy, that there wasn't enough, let alone low carbon. There was availability problems with energy, there was high cost problems with energy, but it was also just huge wastage in getting it to the point of use. And also when it was there, the buildings that were using it, buildings, industry, transport, 70% of energy demand, were using it inefficiently. So by the time we started investing, we knew what these problems were, but we had also started to design solutions to these problems. What does that look like? So if you want to solve the problem that the grid's incredibly inefficient and wastes 75% of the energy before it gets to the point of use, you can generate energy on site, and that cuts out generation, transmission, distribution losses. As our mission as a financial investment firm, we started to develop physically and then financially invest in projects that solve these problems. So we decarbonized hospitals and data centers and hotels using the equipment that we had learned about as an advisor, but then deploying capital to turn the projects into a service for customers. Customers didn't have to spend money to implement the project. They didn't have to know how to implement the project. We would design the project, we would explain how, we would provide the capital, and then clients would pay for the energy service that we delivered for them that was lower carbon, lower cost, and more reliable. Very often, most often out of the savings generated because we were able to make the whole system so much more efficient. That's how we started our journey as an investor, but that's exactly where we are today. It's actually the same fundamental idea we had as we started investing in 2012 in solutions to these problems in buildings, industry, transport. All we've done for the last, I'd say, 14 years is more of the same. And we've now built projects in our portfolios that connect to over 50,000 properties in 10 countries. We've solved these problems for steel mills, chemical plants, very excitingly, the data center market, for hospitals, for government buildings, for logistics parks and facilities, even for residential communities. So this is what's exciting. This basic problem that we identified years ago, there are solutions to the problem. And we've built a portfolio now of over $2 billion of projects which solve these problems. So if somebody asked me today, can it be done? We have quite a big set of proof points.
I want to drill down on that more, but let's first start out with an overview. You've got a couple funds that you're doing. I think your largest one in 2018 you launched is SEEIT, which was the first UK listed investment trust focusing exclusively on energy efficient projects. So first of all, how did the name come about?
Nobody's ever got the joke. It's what my kids would groan and say as a dad joke. It's just see it. Can you see it? But it's the SDCL Energy Efficiency Income Trust. That's what the acronym stands for.
What is the ticker?
The ticker is SEIT.
Okay.
And it's traded on the main market of the London Stock Exchange. And look, the investment thesis was to invest in, I should say, and then improve projects that deliver energy to customers that's lower cost, lower carbon, and more reliable. But through the same techniques I was just illustrating, that is on-site energy generation that avoids the losses associated with the grid, and also projects that reduce the amount of energy that buildings use. So, for example, more efficient lights or heating, ventilation, air conditioning systems. For me, those are the two most impactful, profitable solutions to the energy problem. In fact, it's actually what the acronym of my book means: efficient and decentralized generation of energy. Efficient meaning, can we change our infrastructure inside of buildings, industry, and transport to do the same job or more, just using less energy? And the answer is yes, The Department of Energy in the US says that about 30% of the energy inside buildings is just wasted because it's got the wrong lighting, heating, ventilation, air conditioning system. I agree with that because that's my day-to-day experience. So we invest in solutions to that problem. And then the decentralized generation is things like it's got solar and storage. You just put energy exactly where it's needed and deliver it directly to the end customer. Cogeneration, recycling waste gases or waste heat and using it to create power and steam in the industrial context. So that's what our portfolios do. And that's what See It does. It buys mostly operational projects and then expands them and improves them and scales them up.
Why did you decide to launch as a PLC rather than a PE fund?
It was a PE fund in a sense. We launched a fund backed by the British government in 2014, and it was called the UK Energy Efficiency Investments Fund. It was actually cornerstoned by the British government's Green Investment Bank. So it was the first of a kind fund. It was the first institutional fund in the UK to invest in energy efficiency projects. And the mission of the fund was it's about £100 million fund. The mission of the fund was to design, build, finance, and then operate and maintain a series of these projects, on-site generation and efficiency projects. And the fund had done, I think, a great job because it closed in 2014. And by 2018, it had basically committed its £100 million and it had got its portfolio operational. So what happens is, Scott, in private equity or infrastructure funds, there comes a point at which your investors expect you to exit or recycle their capital. And that would happen relatively quickly, about 4.5 years after we launched it. We looked for opportunities what the best opportunity was for investors at the time. And candidly, I recycled the same idea that we spoke about earlier that I had when I was at HSBC, and we had the same problem in 2006, and said, okay, one of the best ways I've ever seen to exit an infrastructure portfolio that's working great and then to scale up the strategy is to list it on the stock exchange. I did that the first time in 2006. Why don't we do it again with the UK Energy Efficiency Investments Fund? That's exactly what we did. And in December 2018, we took it public, and that was the beginning of See It.
For listeners who are unfamiliar with the structure, can you just explain this type of investment trust structure?
An investment trust is effectively a company. It's a regular company in many respects. It's listed on the stock exchange. Anyone on Apple stocks or whatever can see the stock and buy it through their stockbroker. It's relatively liquid today. The reason it's called an investment trust is that there are specific listing rules when you want to take a company public. There is a chapter in those listing rules which relates to investment companies, and there are certain features that investment companies offer which are typically or historically attractive to investors. So, for example, there are a set of governance limitations that are put around these companies, limitations in maximum exposure to any individual project, for example. So they're built to be diversified portfolios and operate like a fund, but listed on the stock exchange. So that's what an investment trust is. In fact, Scott, frankly, for anybody in America, that's what built the railways across the States originally. For anybody in the UK, there are some companies which nobody knows are investment trusts, like Daily Mail and General Trust. It was an investment trust that owned up media assets. 3i, a very famous venture industrial business, as an investment trust. But, See It joined the ranks of infrastructure investment trusts or investment companies that had started to got listed up. I listed the HSBC one in 2006, and it's become a $10 business here in London.
So it's a completely open fund with immediate liquidity then, right?
It's subject to liquidity in the market, but if any investors want to buy and sell shares, they can take advice from their stockbroker and they can buy and sell shares on the open market on the London Stock Exchange.
And what's the total assets under management?
So the enterprise value of the portfolio is about £1.5 billion, and that's comprised about £500 million worth of debt financing of projects and about £1 billion of equity.
Who are the investors primarily?
It's a blue chip shareholder register thrilled. A lot of it's in the public domain, but the typical characteristic would be insurance companies, pension funds, institutional asset managers, private client stockbrokers, some very large, institutional funds. More and more these days look at See It as a proxy for an operating company, that owns energy assets all over the world.
Is most of the capital in there already deployed?
All of the capital is deployed and it generates cash flows. Those cash flows then allow us to service a dividend. So it pays dividends quarterly.
And targeted returns, what do you shoot for?
The latest valuation that we conducted, and we printed our annual report and accounts in June related to the end of March, the discount rate or the rate of return that applies to our portfolio at its NAV is about 9.5% or about 11 levered. So that gives kind of a sense of what the total return might be expected to be from our net asset value. And I think good news for new investors, not so good news for existing investors, is that the shares trade below net asset value. So some might say it's a remarkable investment opportunity for investors who can buy shares in a company below its net asset value.
What are you benchmarking against? Utilities or what? I guess you're not generating energy, but
in any investment thesis, in an investment case, it's a layer cake is probably the best way of describing it. The base of your layer cake has to be risk-free rates. And then, there are risk premia that attach to the specific, the sectoral, but also the specific risks that you're investing in. So when we look at our portfolio, we'll look at the risk-free rate in the relevant country. We'll look at the risk premium associated with corporate credit. We'll look at the risk premium associated with the liquidity or illiquidity of whatever we're holding. We'll look at whether or not there are construction risks, Scott. So if we're building new projects that put solar on people's rooftops and commercial industrial context, we'll take that into account. We'll take the operation and maintenance risks into account. So it's a stack of risks which have a commensurate return. And that's broadly how we calculate the discount rate or the rate of return that we require on any new investment.
I want to cover the other things you're doing. In 2023, you launched the Green Energy Solutions Fund. This is private equity?
Green Energy Solutions Fund is exactly as you asked me. Why didn't you do a regular private fund? The Green Energy Solutions is a regular private fund. But as opposed to the public company, which invests mostly in operating assets, the regular private fund invests much earlier in the development and construction phase of projects. A typical client of that fund, it's a 650 million euro fund. And by the way, we have 100 million. Within that context, we have a £100 million partnership with the Mayor of London, specifically to do this in London. But what we're doing in that fund is investing in the development and construction of new projects that can decarbonize buildings, industry, and transport. So a typical client would be, I'll give you some examples. You could be a data center operator, right? And you could decide that you need to service your new data center, you need low carbon power 24/7 at a reasonable cost. So our fund will come in and do the work to develop and then invest in the construction and then provide us the energy service to the customer. That's a typical customer. Another type of customer for us would be an industrial customer that wants heating, cooling, and power 24/7 for their manufacturing facilities. It could be a hospital. It could be any other form of large corporate and industrial logistics client. But what the fund will do is invest the capital to develop and construct the project and then earn a return by providing an energy service that's lower carbon, lower cost, and more reliable than the grid.
This is for qualified investors, probably.
That's an institutional fund. The minimum tickets are much, much larger. It's actually closed. We finished the fundraising just above our target size in October last year. And it's characterized by very large financial institutions, again, insurance companies, pension funds, one or two sovereign. And
does this get what one would call private equity returns, or is it a similar profile to the listed to see it?
It gets private equity infrastructure returns. So it gets similar returns to the public company, I would say, because it's investing at a slightly earlier stage at development and construction. It gets a premium return associated with the additional time, cost, and risk associated with that.
You consider all this real asset investing? Yeah. Okay.
Yeah. So
this is clearly in real assets. Yeah.
All of our infrastructure equity portfolios are clearly in real assets. They're all backed by contracts. We own equipment and we're delivering energy services to customers. We do have, and that is the supermajority of our investment portfolios, we do have a private equity capability. So we do like to use our knowledge of how the energy system works, particularly what buildings, industry, and transport need. And we like to use that knowledge to identify companies selling products and services into the supply chain that can help buildings, industry and transport decarbonize, because that's our core business. So we love investing in infrastructure projects, but we also love to try and find companies that are doing a great job providing products and services in infrastructure projects and services into those markets. So we have a private equity business too, and that's something that we're definitely excited about scaling up over.
And that's something that you just went into last year with an acquisition of Volaris, so right?
Correct. Yeah. So we have had a very small portfolio of private company investments inside of SEIT. Actually, about 3% of SEIT's portfolio can invest in companies, and we've had some great success in doing that. But to scale that capability up and to make investments in slightly later stage growth capital opportunities, we acquired a very good group in Greenwich, Connecticut called Volaris Capital back end of last year. They've been long-standing partners of the firm, a team that we knew extremely well. So we're delighted that they joined and merged their firm into us in back end of last year. And that's a business that we really want to scale up because we can help a lot with these companies.
Outside of these investment strategies, you do project management and advisory services as well. Is that correct?
Our funds are not just investment funds. We have active asset management teams at SDCL. I guess if I were to characterize the two types of people in the organization, typecast them, it's physical and financial. So we've got the physical capability of designing and then project managing the construction and overseeing the operations of projects on the one hand. And then we've got the financial capability to evaluate and invest and buy and sell investments. That really characterizes what we do as a firm.
Where do you fall in this? You said you have two types of people, the physical and financial. Are you physical?
This goes back to my your probing questions around my childhood. What are you doing? What are you doing as a arty historian, as an investor? It appeals very much to both sides of my brain. Half of my day, honestly, is spent with customers, like big end-use energy customers, data center operators, big building operators, hotels. I love spending my time in plant rooms and figuring out what the energy solution is to the problem that I'm looking at in the buildings industry transport sector. That's half of my day working with these companies. The other half of my day is spent working with the capital market, with financial institutions, pension funds, insurance companies, the stock market, whoever it might be. I guess it probably is fair because it's my job, but my job is to look after both the physical and the financial side of what we do. But we've got experts who look after both sides of it.
So I guess this summer, it seems like you tried to combine a business trip to solve a problem with a project in Germany with your family's holiday. How did that turn out for you?
It's funny. Well, I was really exhausted, actually. That we'd had a really busy period before the summer. My family hadn't seen me for a long time, and we decided to go away for a couple of weeks to the south of France. And my long-suffering wife was wonderful, organised the whole thing. I had a phone call, actually, from one of my very, very senior member of my team saying, Jonathan, we've got a problem. We've got, one of our suppliers has challenge, I should say politely, in getting us the equipment we need on time to service one of our very big customers. They need to understand how serious this is and fix this problem. My biggest problem was Mrs. Maxwell at the time, because I'd only arrived in France that day. And I knew that to service our physical customer, and frankly, in order to get an investment return for our financial clients, this problem needed to be solved. Scott, this is a biggie. I asked my long-suffering wife if I could possibly get on a plane the next morning and fly to Munich. She knows what I do for a living, so she was okay for me to do that. I went and poured 23 tons of bricks over our industrial partner that was supplying the equipment, and I'm very pleased to say they agreed to deliver on time and on budget. Anyway, I then flew back, and you remember there's that old phrase, no good deed goes unpunished. So I tried to fly back. The idea is I get back for dinner. Flight was cancelled, ended up in Paris from Munich, trying to get back, got on another plane, arrived at midnight in Nice, picked up a hire car that I had hired to save money for the project rather than taking a taxi, took the coastal road rather than the main road so as to be safe. And then my tire exploded, Scott, in the middle of the night. So I then spent 2.5 hours as an English person on the side of the road in the dark on the coastal road in France on the way into Cannes until somebody admitted that they're never going to send anybody to pick me up. So I guess the physical and financial side is, it's that kind of job. It does become, it really does become very physical. There is a big construction, serious industrial side of our business connected to 50,000 buildings around the world, where I have to wake up in the morning every day and make sure our energy customers are getting the energy, the heat, the light, the power, the energy service that they need, which is critical to their operations. There's a financial side. I need to make sure that my investors are getting the return they need. I can't spare any effort in getting there. And sometimes the physical strain of it just manifests. It's a lot of running around the world. It's a lot of carrying bags. And sometimes it's your tire exploding on the side of the road in France. My wife said to me the next morning, to answer your question, was it worth it? I said, time will tell. And I'm very pleased to say that so far, so good.
Just to draw a line under your business model, what is a split of operations in your business? How much of your revenue or your operations are derived from actual investing versus advisory versus project management?
It's almost all investment. Our business model is that we run funds, and we run those funds on behalf of institutional investors that bless us with their trust to invest their capital in projects that are sustainable, not just for the environment and society, but commercially sustainable. Indeed, if it's not commercial, it's not sustainable. That's our regulatory and business objective, and client outcome. What sits on the other side of that, though, is that we're investing in projects that are delivering critical energy services to customers. That's how our funds are deriving revenues under contract. They're getting their revenues from providing energy services through these projects. So we're paid by our investors, but at the end of the day, their returns come not from us, but from the underlying projects that we manage on their behalf. So it's about, spiritually and physically, it's about half and half. Half of our time, more or less, is spent making sure that our physical operations are performing at their peak and the best they possibly can. And we do everything we can to improve those assets, manage the risks, deal with the uncertainties that life offers sometimes. And then the other half of our life is making sure that the investment decisions we're making, the risks, the financial, the administration that goes along with running billions of dollars of institutional capital, that's being done properly.
I know you're operating internationally. So what regions are you active in? What countries do you have actual employees on the ground?
As an investment firm, we have about 55 people here at SDCL that work directly for the firm, but we have somewhere between 350 and 400 people under full-time employment through our portfolio companies and projects. Those portfolio companies for our projects, about 70% of the value is in the United States of America. I think this is right, although we may have done a project but I think right now we've invested in every state in the United States other than Hawaii, which is nothing wrong with Hawaii. We just haven't managed to get something done there yet. That's about 70% of our capital. We've got a very large footprint and growing footprint, rapidly growing footprint, I should say, in Europe. The Republic of Ireland is a really big market for us. That's obviously a hotbed of the data center market, which is a very large focus for us as an industrial vertical. UK is our home country, but has a relatively small proportion of our capital invested here, looking to do more, hence our partnership with the Mayor of London to launch a fund specifically for the London market. Spain, Portugal, so the Iberian Peninsula, we've got circular economy projects, cogeneration projects. Sweden, we've got a fantastic network in Stockholm. So we are actually Stockholm's gas grid, but don't worry, it's a green gas network. It's taking mostly the waste gases from wastewater treatment plant that would otherwise be polluting, and we use those as the gas network for Stockholm. And then we've got a small footprint in Asia, actually. Going back to my HSBC heritage, we've had an office in Hong Kong, we've got an office in Singapore, and we invest in projects in Singapore, Vietnam, and we're moving into Malaysia.
I think you've hit all around this, but I'd like you to succinctly tell me what's SDCL's theory of change and the problem or the problems that you're trying to solve specifically.
Our theory of change is that we think that the intersection of the energy with the economy and the environment, the interface of those three elements is the most fundamental issue that we need to look at for the next generation, primarily because of climate change, but also because of other socioeconomic factors that emerge and even geopolitical factors that emerge. So our theory of change is that something has to change and that nothing much has for the last 20 years. And I don't mean that in the sense that we haven't been well-meaning. And I'm not saying that we've had bad policy design, but I'm being realistic. So come back, I'll give you a theory of change in a second, but what's the theory of non-change? The theory of non-change is that how can we say that there's been change when over the last 20 years, after $9 trillion of investment in clean energy and in the grid, with everything that we've said and done, with the UNFCCC, with Nobel Prizes, with movements, how can we say there's been change when particulate emissions have been going up about the same every year over the last 20 years with barely any detectable difference? How can we say that we've made a change when the proportion of fossil fuels in the global energy system is about the same as it was? We've added, there's more of everything. We can say that the energy system of a century or 2 centuries ago was bioenergy and now it's dominated by different forms. Well, we just use more bioenergy than they did 100, 200 years ago. It's just more of everything, right? So that's the theory of non-change. The theory of change is this. What if we needed and wanted to do something about this? What if we needed to cut carbon? What if we needed to improve resource efficiency because we just are using much more than the planet can produce sustainably? Our planetary boundaries have been blown over the 9. We're just using too much. We're probably using 1.75 planets of resources a year. So what exactly can we do about this? So my theory of change is as follows. The largest, fastest, cheapest, and cleanest source of greenhouse gas emission reductions and reduction in extraction and social destruction associated with extraction of minerals and metals. The largest, fastest, cheapest, and cleanest solution to that is being more efficient, doing the same or more with less. So just at the same time, it's not to denigrate it, just at the same time as we spend the next decades innovating and building the best, cleanest infrastructure we possibly can, renewable power and the rest of it, the theory of change is we have to be more efficient. We have to cut out as much as we can, the 75% of the energy, half of the food, and a third of the water that the world's wasting. And by the way, Scott, if we don't, we're not going to get anywhere. Not with net zero. We're not going to have a sustainable economic environment. And we're going to keep having wars over the stuff that we're fighting over.
I guess you've identified energy efficiency as the low-hanging fruit of this problem out there. What does it mean in practical terms, and what does it mean practically? Because I'm sure there's a lot of people listening who haven't thought much about this as an investment concept. I'm sure a lot of people have heard it referred to because it's not an uncommon term in the business. It's thrown around a lot. But I want to make sure we're all on the same page today, what it means to you and SDCL, because I want to get down into how this generates a return.
I'll start with like a very, very pure version of efficiency. So let's say that you own a portfolio of 800 buildings around the country, and let's say that you're a bank. Santander Bank is a great example of this in 2015. At the time, certain clients still suffer from this, like the NHS today. But at the time, Santander recognized that almost all of its lights were inefficient. Like, for example, they had sort of regular light bulbs. By changing those light bulbs to LED light bulbs, they identified with a technical partner of ours at the time, GE Lighting, that they could dramatically reduce the amount of energy they were using. Now, they didn't need to turn the lights off. Like, they could have the same lighting product, even better actually, because it would require less maintenance. It's just that it would use much less energy. So you could take out of a ceiling a 60-watt lamp and replace it with a 6-watt lamp, and it would make the same amount of light. But de facto, it would reduce the amount of energy like for like by 90%, right? So this was kind of the opportunity, or what you would refer to as low-hanging fruit in 2015. what we did is we worked with GE Lighting to design a system where we didn't just replace one of those light bulbs, we replaced 90,000 of them in 800 buildings, all in one go in a 9-month program. Okay, here's the other problem. This is the financial problem. If you're you might think Santander has all the money in the world, but it's still a company with an operating budget. So the cost of doing that was about $20 million. Now, that $20 million was not a normal operating budget for their facilities management business. Second of all, it required an extraordinary level of project management and coordination. So it wasn't just capital, but it was help. Somebody had to take responsibility for changing 90,000 lights, right? So that's where we stepped in, and we wrapped the project up to make sure that it had the right delivery capability to design, install, and operate and maintain. And instead of Santander having to pay $20 million to implement the project, we paid the $20 million and we charged Santander a fee to provide light as a service to them for 10 years. So that's how we turned it from a problem into an investment. We made our investment, which was the capital expenditure to install the project, and our return was the cash flows associated with the service charge that we charged Santander. Now, for Santander, it was a great deal because the payment that they made to us under our service charge, which was our income, our return on investment, was less than the payment that they would have made had they not changed their light bulbs. So actually, they just paid us out of the savings.
When you say less than the payment they would have made, is this for their power payment?
The payment that they would have made was two things. Previously, going back to my example of a 60-watt lamp for a 6-watt lamp, for every single one of those lamps, they were paying the money involved with running a 60-watt lamp rather than a 6-watt lamp. So it was much more expensive. After we installed the lamps, then, of course, the price went down very dramatically. So it involved a very substantial financial saving for Santander. But in addition to the financial saving, if you think about a lamp burning 60 watts compared to a lamp using 6 watts, the carbon efficiency was so much better afterwards than before. So Santander were getting two benefits out of this. It was a significant cost reduction, but also a significant carbon reduction. And then there was a third benefit, which was the quality of the infrastructure. So once we'd made the investment, they used to have people running around the country in white vans doing emergency repairs for light bulbs that kept going out. But as we all know, LEDs come with warranties, 5-10 year warranties, which means that you don't have to replace them. Or if they did, they'd have a phone number they could call and somebody would come out and replace it for them. So we delivered the project as a service for Santander. There was no upfront capital cost. They paid us a return on our investment, our $20 million, over time as a service. They paid for a light as a service over 10 years. We earned a return on our investment that was acceptable to us. Santander paid us for that service, but it was less than they would have paid for those very expensive 60-watt lamps.
And is this service something that is effectively calculated and negotiated when you go in with the project, or are you paying the power bill and charging them what they were paying before? How does it work?
They carry on paying their energy bills. They're just paying less because they're not using as much energy. They pay us for the lighting as a service, but they don't pay us, Scott, if the light isn't available for use. So they pay us so long as the lights are available, so long as they don't degrade below a certain level, so long as the color temperature was what they wanted, and so on. So there are key performance indicators. So that's a very clear. We've done many of these projects in the UK, in the US, and around the world. But using finance can spread the capital cost of an asset over its useful life, right? And also in infrastructure investors like ourselves can take risk. We can take the risk on the design, the implementation, and the operation of projects. So that's what this does for clients. You know, we design, install, operate, and maintain projects with our industrial partners, and then clients can pay for the service. They only pay to the extent the service is made available to them. So for example, lighting, or you could do this with cooling or heating. But in each case, the client has the benefit of paying for the project as a service, but the payments they make, including our service costs and all the electricity costs that they're paying to run their system, are less than they would have been had we not done the project for them. So that's on the kind of the savings side. something that we learned over the years, and I referred to it at the beginning, is that, and here's a bit of a tragedy, you can make your building. This was a heartbreaking moment for me because I'd done all these projects for Santander and all sorts of other customers, and we tried to make these buildings as efficient as possible. And then the realization was, oh my God, like actually most of the energy has been wasted even before it's got to the building. Here we are. This is what we were saying to the Mayor of London. Well, we've just launched a new fund with them. Here we are in London. We could make all of London's buildings more efficient, but 2/3 of the energy has been lost before it gets into town. Going to the point that I made before through the extraction, generation, transmission, and distribution process. So what can we do to solve that problem? So that's the other side of the coin, and the other side of our investments. And to solve that problem, you asked about practical examples. We will build the energies, that is the power or the heating or the cooling service, at the point of use. So rather than if you've got a data center, Scott, in the middle of town, rather than you having to rely on the grid, where by the time the energy's got to the data center, 2/3 of the energy's been lost on the way, instead we'll build the energy system right there at the point of use, and we'll produce as low carbon as possible, 24/7 power, cooling for a data center. If you're a hospital, we'll provide power, heating, hot water, cooling. If you're a logistics facility, we'll put solar panels on your roof. And instead of you losing the energy through the transmission and distribution system and paying your utility bill, half of which has got nothing to do with wholesale energy prices, it's got to do with the cost you have to bear for the network. Instead of doing that, we'll produce the power cheaper, cleaner, and more reliable for you on site. The UK's, we were joking about it before we got started, but the UK is not famous for being a very sunny location. But from 2019, it's been cheaper to buy solar power that you produce on your own site in an industrial context than it has been to buy it from the grid.
Is that what you mean, that you invest in edge markets, which is efficient, decentralized generation of energy? I mean, if only there was some kind of book we could all buy that would explain all of this. Because this, for laymen like me, this is complicated,
It's funny to say that. Well, I have to say, you probably got the tone of it. I've spent lots of time in investor meetings and get terribly excited about how crazy the world's energy system is, but also what the solutions might be. And I think my investors anyway, had heard enough of that. So I decided to write it down. And I think also to prove it, because it is absolutely crazy. I really do think, and we've only talked about energy today, there's chapters in the book about how terrible the water system is and the food system is and how the solutions to some of those problems. But that is why I wrote the book. It's called The Edge. It's a slight double entendre as well. The Edge is obviously the business thesis that I have, efficient and decentralized generation of energy. But it also goes back to those childhood days about worrying about the world and stuff and politics. Because the edge is what happens if you literally translate from Russian into English, Ukraine. It means on the edge. So the other side of the story that I cover in the book actually is not just how competition for resources is creating climate change by burning the stuff and competing for the stuff and extracting stuff, but it's how competition for resources is creating conflict. Coming back to what sustainability means for me, that is actually about the environment of people, about environment and society. It's about saying, okay, if you can be more resource efficient, it doesn't just abate and mitigate things like climate change or environmental degradation. It actually mitigates societal and geopolitical problems like chasing after gas, which after all is a huge feature of why Russia invaded Ukraine, or what's happening in the Eastern Mediterranean today, or chasing after stuff, which is creating tension in the South China Sea, or new arena for conflict opening up, which is where the book starts in the Arctic. So, I think that's really what sustainability means to me. When I think about my children and my family and their lives over the next generation, our lives are going to be determined, I think, by whether or not we can, as a society and an economy and as governments, get our act together. And if we can start to be more efficient, not only is it better for the environment, it's better for the economy. By you doing less, we can be more competitive, using less to do the same or more, we can be more competitive, we can be more productive. Sustainability can actually start to become synonymous with growth, not sacrifice of economic growth or GDP on the altar of the environment, but instead of the actual fundamental source of competitiveness and productivity. For me, that's what sustainable investment is about. Degrowth, for me, is not a recipe for responsible investment.
So the name of the book is The Edge. Is that it?
There's a subtitle, which is How Competition for Resources is Pushing the World and its Climate to the Brink, but not to be alarmist, what we can do about it. And it's absolutely looking at both sides of the coin. Let's be really serious and real about the scale of the challenge that we face, but also that this is a solvable problem. And in fact, I think it's the biggest opportunity of our generation.
So we'll put a link to that in the show notes for anyone who wants to get way down into this. I'd like to drill a little more into your See It investment vehicle and strategy. Who are typically the end users in these projects?
Big market for us is actually steel. Not tremendously fashionable. Doesn't sound particularly green, does it? Steel is a big deal. I mean, everything relies on it. Really, you can't build wind turbines without it, Scott. So, you have to accept that it's got a role to play. A lot of the steel industry, although it's moving to electric arc furnaces to be more environmentally friendly, among other things, it still relies on blast furnaces. So, for example, we have a major project in See It's portfolio that I think is absolutely fantastic. When you've got a blast furnace, typically they can reject gas, hot gases, and they literally boil the atmosphere. The project that we've invested in See It's portfolio serves Cleveland Cliffs, the old ArcelorMittal USA steel mills, and US Steel, famously going through a merger at the moment. And it serves those steel mills by capturing waste gases, waste heat, effectively, coming out of the blast furnaces. What would otherwise be pollution boiling the atmosphere is captured, Scott, and it's piped back into turbines. And the turbines then produce steam, which is needed by the steel mills, and power, which is needed by the steel mills. So what it's doing is it's recycling energy. What would otherwise be waste, part of that 50% of the world's energy that goes up in smoke into space, what it's doing is it's capturing it, recycling it, and putting power and steam back into the industrial process. And it's doing it at big scale. We've got about 298 megawatts of on-site generation, most of which is recycled energy. It's so impactful that it gets about 1.5 clean energy or renewable energy certificates for every one equivalent megawatt in the solar market, for example. So that's how beneficial it is from a pollution prevention and energy recycling perspective. That's what I would call, people call that hard to abate in the steel industry. Steel, cement, chemicals, and plastics is about 40% of the world's greenhouse gas footprint. So, that's a big one as an example. We've got a project in the northern side of New York State, and that runs 16 utility services on site for about 116 customers, big logistics and fulfillment customers through to the food and beverage industry. So that's a very interesting network. We have one of the largest solar and storage platforms in America in See It's portfolio, a company called Onyx Renewables, which does solar and storage across schools, hospitals, government buildings, commercial and industrial facilities nationwide. We've got lighting as a service, going back to my Santander example, across the country through one of our portfolio companies. So that's what's in See It in the US. In Europe, I mentioned Stockholm's gas grid, which is fueled mostly using the gas that would otherwise be spewed out of the back of wastewater treatment facilities, but instead is captured by us and used as the gas network for Stockholm. We've got projects that serve the olive industry in Spain, the paper industry in Portugal. And then you asked me to be insinuated that steel mills in the United States weren't sexy. So let's try this one. Hyperscale data centers in here in Europe is a market that we've been very focused on for years because See It, for example, got started. One of its earliest investments was owning on-site energy generation systems for companies like Citigroup, where we own and operate their critical energy service energy center for their data center here in central London. So that gives you a sort of flavor for the portfolio. It's high quality projects. It's contracted with end customers. The contracts deliver customers energy at an affordable price, which is typically lower, substantially lower than the grid. Energy that's designed to be lower carbon than the energy system of the countries in which it operates, and energy which is designed to be, and this is really critical for sustainability, reliable. Because we have to wake up. I have to wake up every morning with my 50,000 customers. So it's got to be available. It's got to be reliable. It's got to be secure. And if you're a data center, a hospital, a steel mill, a manufacturer, you're going to rely on these projects to deliver the energy services that you need when you need them. That is the characteristics to its portfolio: cheaper, cleaner, more reliable.
How do you define your investment universe? I mean, what are the key screens or hurdles that have to be passed for you to move forward on something?
The primary philosophy behind our projects is going back to the problem we're trying to solve. It's not how do we sell more solar panels or batteries or hydrogen fuel cells. It's how do we get the lowest cost, lowest carbon, most secure solution for our customers. So the first question is, who are the customers? The customers are buildings, industry, and transport. That's where 70% of the world's energy is used. That's where the battle's going to be won or lost around carbon, around the economy, and around the environment and society. It's the actual end user. Most people think about the grid, Scott. There's nothing wrong with the grid. It doesn't have any feelings, so it's convenient. But the buildings, industry, and transport, that's where the action is. So that's our customer. So that's how we define our universe. Then what's their problem? Where are they? What do they need? It's typically one of those three things, or all of them together. And then we'll design solutions to those problems, or we'll invest in solutions to those problems. And the solutions take many, many manifestations. But it's either on-site generation or it's projects that reduce energy consumption, lots of different technologies, but you're solving the same fundamental problem every time. How do I produce a solution for this customer that involves wasting less energy than the grid?
So one of the key differentiators of your investment strategy, if I've understood this right, is there's no upfront capital required for the end user by the target company that is deploying the energy efficiency project. In the example you gave me of Santander, where you're providing light bulb service or lighting service, I don't know how you described it, does that have a term that expires? Because that's really kind of a service that's got calculated savings, as opposed to when you're constructing decentralized energy generation. There you've got a real PP&E, and I imagine that's a standalone asset that you eventually maybe spin off.
You're entering into a contract, let's call it 10 years, to provide light. You could also be providing another service, another energy service like power or heating or cooling. So our projects will own the equipment that deliver those services, lighting, heating, power, or some derivative thereof. It's typically under a contract with a limited life. You're right, about 10 years, 15 years. Some of our contracts go 20, 30 years, but the typical average life in our contract is actually about 15 years. So throughout that period of time, we will provide the energy service to the standard documented under the contract. Scott, if you're a data center and you need energy made available to you when you need it, you pay us our service charge. It could be a 10, 15-year contract, and we will deliver you the energy service. And to the extent that we don't, you don't pay. And all of our contracts fundamentally work in a similar format.
Let me move on to drilling down on impact. How do you measure impact and monitor impact? Are there KPIs that are super important to you, or how do you do this?
We think about this very, very deeply. We actually won the ESG Communications of the Year award for our public company for CET last year, and our Business Green Award this year. I think it's working, but the thought process is, how are we saving energy, and therefore can we count that in carbon emission reductions? It's a monitoring, measurement, verification exercise. We then translate that into carbon emission reductions. We also look at other environmental and social metrics that we publish in our ESG report. The calculations and quantification of that is then made available in the public domain through our annual report and accounts for the public company and to all of our institutional investors through the private funds. So what success looks like to us certainly is health and safety first, is in providing around the clock energy services where we need, but from an environmental reporting perspective, It's carbon emission reductions, and it's also to the extent that we can quantify them and articulate them, the other environmental and social benefits associated with what we're doing. I firmly believe that we've got a big problem to solve in this world, not just to create more clean energy infrastructure, but to stop wasting this ridiculous scale of waste in the system. So, we calculate the impact that we're having on that because we think it's the largest, and sort of fastest way of cutting carbon. Last thing I'd say on that side is a bit higher level than your question, but I've just got to say it out loud. I've been doing this for 17 years, and I'm sure there's lots of people listening today that might have seen something that I haven't, but I've never seen any evidence of anything that can generate energy with no carbon. There's embedded carbon in any form of energy generation. However, I think it's perfectly possible to create a negative carbon energy project by reducing the amount of energy that's needed to do the same job. That is, reducing energy demand in the economy. And that takes carbon out of the economy. So if we can come up with better solutions around the E and edge, efficient solutions that just involve using less carbon and less energy to do the same or more work, and we can do decentralized generation so that we can cut out waste in the extraction, conversion, generation, transmission and distribution process, that's negative carbon. That's carbon out of the economy. So while it's incredibly challenging to generate zero carbon energy on the supply side, it's extremely exciting to think that you can measure, quantify, and deliver carbon savings on the demand side.
Based on what you just said, you feel like there's huge opportunity scope that remains to generate additional impact, that we're at the front end of the runway for your strategy.
I think we're just getting started. I mean, I'm delighted to have been at the helm of SDCL for 17 years. I fully hope and expect to be here for the next 17 years. I've created the firm that I want to work in, and I'm doing what I think is the highest impact job I can. I also feel like we're just getting started. As going back to it, over the last 20 years, if you measure the incredible success, I'm so happy walking around COPs these days with this level of interest and finance and media attention. But it's just fantastic to see the level of interest and experience that we now have as a society in building renewable power. But nothing like that $9 trillion has been invested in solving the problem that we've been discussing today. The return on investment for that, I think is absolutely extraordinary. To give you one little example, nugget, which I always like to give. Obviously, we're on the brink of an election in the United States, and we just had one in the UK. So I'm going to say this just as a little example of something the government in the UK might like to think about. But the biggest energy user in the UK is the National Health Service. It uses about 5% of all the energy in the UK. Going back to my lighting examples earlier, less than half of the NHS's light bulbs have been changed to efficient lights or LED. Just doing that would save the NHS £1 billion by the end of the decade, let alone being the fastest source of greenhouse gas emission reductions and creating a better lighting estate for patients here in the UK. Just gives you a sense. Yes, we're at the foothills. The way I like to think about it is I spent 17 years getting to the equivalent of the base camp of Everest. I'm very, very pleased and proud to be at the base camp of Everest. We're backed by some of the world's biggest financial institutions who've been supported by governments around the world. I never take anything for granted, and we have the privilege of serving our customers with energy, but it really is just getting started.
This all sounds great. There's no upfront cost, and once it's up and running, there's operational cost savings for the target company on an ongoing basis, along with better energy security, market returns to investors. So it sounds like a win-win wonderland. What's not to like? So give me the elevator pitch. Why should end users, investors, governments, the NHS, why should they be queuing up to get involved in this now, and why aren't they?
So they should be. I think this is the major priority. By the way, the European Commission has a new policy since the Russia and Ukraine invasion. It's called energy efficiency first, not second tomorrow, also maybe one day, good idea. Energy efficiency first, because it recognized that for every unit of gas they don't use is 2.5 they don't have to buy from Russia, which they can't anymore. So now America. So I think governments are clicking onto this. The United States, about 20% of the Inflation Reduction Act goes into it. I come back to the UK, just had a new change of government, and I think it's very important. Why hasn't it been done before? Anything like the scale that it needs to and deserves. It's hard, Scott. It's fiddly. You're not providing energy services to the grid under a repeat business model. You're designing typically bespoke solutions for customers with feelings in the buildings industry and transport sector. It's hard to do the same thing and scale and replicate. You have to find models to do that. So it's a harder thing to do. But I think that is where investors like us, backed by the sorts of financial institutions that we are, can design over time models that are scalable and replicable. And we've found ways to do that. It's where governments need to start to regulate and prioritize. I think if I'm being really bombastic, I'm thrilled that the British government thinks that we can be a clean energy superpower and energy independent, but we're not energy independent. We're getting more dependent, and we're not a clean energy superpower because, the best thing that we're really good at in the UK is offshore wind, which we can do at massive scale. But electricity is only 17% of the energy system in the UK. So even if we greened it all, we've got a long way to go. So if we can start to be realistic, then that's where you land on efficiency. I think that this is, in the US, I think that this is an issue which should appeal across the aisle. I don't think it should make any difference whether it's a Republican or Democrat on the subject of efficiency. You've got the world's richest man who's potentially looking at a role to be the efficiency czar in the United States, and you've got an administration today which has pushed the Inflation Reduction Act into efficiency for lots of reasons. So, I think that this is an issue which politically cuts through. It's about being more efficient, competitive, and productive. The reason it hasn't been done at this scale is two, one of which is facetious. Real men built power plants. That's what somebody told me once, which is a horribly misogynistic point, but frankly is the way the energy system works. And the other reason is because it's harder, because you have to design bespoke solutions. It's not what the utility sector is set up to do. It's set up to be centralized. So decentralizing this market needs a new business model, a different approach, and that's why we set ourselves up. That was the gap that we've stepped into.
But are there some key risks to your strategy?
At different stages. So there are two different stages. It's building things and operating them. So building things is always risks. You've got to manage and eliminate those risks. So it's getting the right design, construction, managing your supply chain, getting up in the morning when you're in France and flying off to Nice to Munich rather to go and make sure your suppliers on budget. Yeah, and make sure that you don't run off the road when your tire explodes. So yes, of course there are risks during construction, but they should be managed. By the way, there are plenty of risks involved with building a new nuclear power station. I do not mean the uranium. Think about how long it takes, how fast they run out of over budget and over time, right? So the same sort of things apply. You've got to manage that risk. And then, during the operation and maintenance, you've got to build with high quality. And one of the things I love about energy efficiency is we are not sitting around waiting for the technology, Scott, to be invented. Well, oh my God, in a few years, will we possibly be able to do X, Y, and Z? I mean, I'm so excited about what's going on in things like, carbon capture, various other technologies, see what happens in the hydrogen sector. But you know what? Right now, today, all the technology exists substantially to deliver the change that I was talking about all day. So, that's exciting. But somebody's got to make sure it's operated properly. So, of course, there are risks, but that's what infrastructure investing is all about, is investing in risks that can be identified and mitigated. That's what a professional institutional investor can do.
You just alluded to something that is one last thing I want to ask you about. When I look at your portfolio construction of See It, when I look at it by the technology that you're invested in, I see solar and storage, I see district energy, I see CHP, waste gas and natural gas, I see gas distribution networks and EV charging, and I see biogas and lighting and a few other technologies, but I don't see anything about Gen 4 nuclear. I've heard Mark Andreessen say that he doesn't think that people are serious about climate change and sustainability because he says, we already have the answer, which is nuclear power. He says Gen 4 is safe, it's clean, it's always on, but no one seems to want to talk about it. And so he says he just doesn't bring it up anymore. What does Jonathan Maxwell say about that?
I'm going to start with a complaint. Okay. I'm going to complain about this for this reason. If you put nuclear fuel into a power plant, basically putting uranium in, if you put nuclear fuel into a power plant, half of it goes up in heat, just like it does in a gas-fired power station. So that's my complaint. Okay. That's my first complaint. You might not be burning fossil fuels.
Part of the 75%.
Right. So, so if we're going to do something with nukes, please, can we just capture the heat? Can I just ask that? Right now, you might have to say, okay, well, I need a small modular reactor to do that, and I'll locate it next to a data center or a steel mill. Fine, as long as what we can do, please, is capture the heat, because that heat is really valuable, and using that heat displaces the requirement to get it from fossil fuels. Right. So that's my first complaint against nuclear, but it's actually not the conventional complaint. If we can create a model, an economic model that somehow can replicate designs, because nuclear's got a very similar problem in some ways to energy efficiency. It's hard to scale and replicate. But if we can get a scalable and replicable implementation of projects, and we can make them the combined electrical thermal efficiency get to standard, then I think nuclear has a fundamentally more important role to play than it plays, which is already important in a lot of economies like the UK, the United States and France, for example, where it's supercritical. So, nuclear is a very big part of the story. I'm massively excited about the sort of on-site solutions that could be done at 100, 200 megawatt scale with nuclear. The challenge to that is that the reason they're not in SEIT's portfolio, which is today, is that they don't exist today at commercial scale. They're going to exist, I'm told, in the early 2030s. So here I am. I'll still be here to sign the so we will be in the queue to invest in a low cost, reliable on-site generation for nuclear. We're probably not needed for the world of grid connected utility scale power gen in the nuclear sector. But if there's something that we can usefully do to deliver safe, clean, reliable, low cost energy through on-site nuclear going forward, then we'll be extremely interested. But I do suspect it's going to be another decade before we've got anything.
Okay, full disclosure, I'm someone whose last science classes were in high school physics, and I only got through that class because my girlfriend did my homeworks for me. So I don't know what I'm talking about. All right. But when I've listened to Mark Andreessen talk about this, it sounds like it fits perfect into your edge in Gen 4 in particular, not these giant things that we're used to thinking about, but it sounds perfect for decentralized power generation. And even the waste disposal, it somehow consumes its own waste or something, but I don't know what I'm talking about. I'd really like to have Mark Andreessen on the show. So Mark, if you're listening, let's talk. But I also have to agree with him. I have a lot of people on the show that are specialized in this sector, exactly like we're talking to you. And he's right from the standpoint that nobody really wants to talk about it. And what I just asked you, I've asked others like Ben Guest at Gresham House. And when I do bring it up, people say, well, we should look into it. And it should be part of the discussion. And what interests me is he says the technology, we already know how to do this.
Tell him to give me a call. I've got steel customers where I deliver on-site generation. If you can deliver a project that's cost competitive and safe, and we can run 24/7 for our customers, would be incredibly interested.
Anyway, listen, I'm conscious of your time. I think we've got to the end, and I've just got a few last rapid fire questions to wrap up our talk here. And just give me whatever comes to your mind. If nothing comes to your mind, feel free to take a pass. But if you had to name the one most important challenge in the sustainable investing space at this time, what would it be?
Chasing shiny things. People get really excited, and I think it's fine. And you mentioned this sort of sexy. I mean, the biggest news in the energy sector was batteries until people realized they've only got a minute and a half of storage in the whole of Europe. And then the market collapsed around it. By the way, batteries have a huge role to play. I've got one in my garage at home that runs my house. It's fantastic. But, it's part of a solution. It's part of a toolbox. It's not all about this, nor is it all about hydrogen. So the biggest challenge in sustainable investing and policy making is it typically gets all about this, about something big and shiny and exciting, and everything else gets forgotten about. So actually, that's the biggest challenge in the sector. What we really need is an understanding about how the world really works, how the energy system really works. And once that's in place, government and, frankly, investors to do something about it.
What do you know now about sustainable investing that you wish you knew in 2007 when you founded SDCL?
A lot of what I know now is about people. People are really the success factor, but they can also, particularly governance and management, and in the financial sector, the wrong shareholders can also create, more problems than are necessary. So I think, sort of what I know now, I think is better governance and better management systems, and applying the best of those patterns to business today, I think can help us a lot.
You're an investor. You don't have to name names, but can you describe to me an investment that you made that you were convinced of at the time you invested, that it ticked all your sustainability boxes, but in the end, it just didn't turn out and went pear-shaped? And what did you learn from that experience?
I'd say that there are a couple of examples that are a bit early to tell. Like great technologies, like me, you probably grew up with Betamax, right? You could have said that Betamax was better than VHS. It just didn't work in the end because it wasn't marketed properly.
I was a proud owner.
So for me, it's those kind of Betamax technologies, which doesn't denigrate the technology. It denigrates the management system and governance wrap that goes around it, and the investors. So but I'd still say it's too early to tell. Thank God so far we haven't had anything terminal, but I would say we've backed some great technology solutions in the private equity and venture portfolios that we manage, which I'm massively hopeful for. I won't name names, but ultimately the success will be about how they're managed, governed, and owned.
Describe to me an investment that you had some level of skepticism, either at the time you invested, or maybe because of this skepticism, you ultimately passed on it. And in the end, it turned out way better than you thought. And you were pleased you invested, or if you had passed on it, you wished you hadn't. And what was the lesson learned from that experience?
On the East Coast of North America, about 6 or 7 years ago, we were invited to invest in a project, the type of which would probably have fallen into my never bucket. And my never bucket was included not wanting to use chicken shit to make energy. Now, I was convinced at the time that it was going to be fine, Scott, and that we should invest in this to power project. And it's worked fantastically well. And, we've had many other projects that we've invested in that require our time and love and attention. And I have to admit that one of the ones that sent my wings and feathers flapping at the time, but extraordinarily has taken no time at all since we made it. So it's interesting, a good lesson to keep an open mind.
But what was the lesson that you learned from that? Was just to keep the open mind, or what?
I think keep an open mind, have a great team that can identify technology risk, put wraps around it, put solutions around it, and not to get in my own way. Sometimes, the things that I'm good at, and just trying to assess the conversion of a certain type of excretion into energy is probably something I need to rely on my team for.
And if someone wants to get into the sustainability investing space, where would you advise them to cut their teeth, or where to start?
If I was to start all over again today, there are certain things I probably might not do, Scott. I have to say, launching a business from zero and building it up, just on the eve of the great financial crisis and thereafter, it took a lot of energy and effort. So I'm not necessarily going to ask people to go through the same washing machine on that. First of all, I think it's an amazing time to come into the sector. I think we're going through another phase of almost like a sort of renaissance or sustainable industrial revolution. I think it's a really important, exciting time. The scale up of technologies. I think you've got new solutions coming down the scale. I would probably start somewhere in the engineering sector. Design, planning, engineering. I think being in the infrastructure investment side as well, to be able to understand how projects work. Those two aspects would give you enough knowledge about the physical and financial side of the business to be able to, I think, start to see the patterns and pick some of the winners. I think for anybody looking at sustainability, right, in general, this is the biggest sectoral theme of the next generation or two. I used to say sort of facetiously, I hope my children can do something different, like go off and be tennis players or something like that. But actually, I think the market's probably a fantastic place for them to provide services to. So,
Jonathan, I think we got to the finish line. You've been very gracious with your time today. I really enjoyed this. It was really good talking with you. I learned a lot. It is a unique strategy. I'm actually not really aware of anyone else doing that. But I appreciate you taking the time to come here today and spend so much time telling me about it.
So thrilled to be invited, and you've got the biggest platform of its kind, Scott. So congratulations, and I'm thrilled to be able to talk to you on the platform.
Now tell everybody about your websites and your social media and all that good stuff.
I love the business that I'm in and the investments that we make, but I also find it's extremely important to have conversations like this to talk about, how extraordinarily inefficient the world is and what we can do about it. So as we've discussed, I wrote this book, The Edge. I publish a Substack every month, or if I get around to it a bit more frequently. So that's available on Jonathan Maxwell on Substack. I speak regularly on different types of media platform, and love engaging with people on the subject.
And website for, I guess trying to remember, what is your website?
The website for the business is SDCLgroup.com. And then we have a website for the book called theedge.com. But most of the work that we do, or I do, on narrative and storytelling and news commentary is on the Substack, which is, you just go onto Substack, type Jonathan Maxwell, and you'll find me and all of my musings easily available.
So everybody go out and buy a copy of The Edge. Check out Jonathan's Substack. And what's the best way for people to contact you?
Through the Substack, there's contact details. TheEdgeBook.com is also the-edge-book.com is also a great conduit to do it. And I'm based here in central London at Sustainable Development Capital, Vine Street. So can always send emails or letters here.
Don't go outside of zone 1 or 2. You don't know anything about those people.
Scott, we're invested nationwide, but it's a true story. I have a sustainable walk to work in the morning.
Okay, Jonathan, this was great. Thanks again.
Thank you so much. Thank you.
All right, goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.